Hi everyone, welcome to mykayaplus YouTube channel. My name is JP. So you are going to watch a previously private video made for our Premium Club members. So as mykayaplus slowly renew and update our Premium Club services, we have decided to make this private video into a free content for your viewing and learning pleasure. So we hope that you enjoy this lesson and this video.
Okay, so I will proceed with the definition of multibagger. So if you can see multibagger, the meaning straightforward is one bag of money or one bag worth of asset can continue to grow and continue to compound and to make another bag of money appear, and the process can continue to eventually grow more and more bags of money. So very straightforward, the direct definition of a multi-bagger is stocks that can actually go up not just by 100%, but by 200%, 300%, and even 400%. So you will be wondering, who is the person who actually coined or invented this term, multi-bagger? So it was coined by Peter Lynch, one of the famous investor in his 1988 book. So in this book, One Up on Wall Street, he actually termed this terminology multi-bagger, meaning to say that if a stock, if when you buy it, if it goes up in terms of the price by 100%, it is a one bagger. But if it goes up by 200%, 300%, and 400%, and continues to do so, then it's a multi-bagger stock. So the theory or the rationale here is to find companies where the stock price can go up, not just 100%, but it can continue to go more than that. So of course, it'll be very enticing, exciting for investors. Wow, if I can really get a stock to hit not just 100%, but 200%, 300%. And the very odd thing about finding multi-bagger stock potentials is that you just need to buy, study first, of course, study all the characteristics, the criteria, the business model, and then you buy it, and then you just hold it because you are very confident that no way you're going to sell this stock because the stock is still continuing to grow, is still continuing to give you very positive vibes. The business is still very strong, and once the business continues to grow, it's very straightforward that people will want to pay a higher premium or use a higher price to actually obtain the stock price. So it will actually push the stock price up, and then that's where you see your 200%, 300% just by holding a stock. Once you finish doing all the hard work, buy it, hold it, and then you will just see that the stock can potentially give you more than 100% kind of return. So this is terminology or the understanding behind what a multi-bagger stock is like. So of course you can tell me, hey JP, very easy I think I see a lot of penny stock in our Bursa Malaysia, right? Started off maybe at just 10 cent or 20 cent per share. And then suddenly people going it up to, say, for example, 40 cent or even high up to 50 cent, 60 cent. Then from 20 cent to 60 cent is already a three bagger already, go up by 300% already. So anyone also can find a multi-bagger stock, right? But the problem is this kind of multi-bagger stock, it's not a multi-bagger stock, but I would say it's a pump and dump. So you see, suddenly at one time there's huge attention to this kind of stock, drive the stock price up from penny 20 cents all the way up to 60 cents, but then it comes down very fast. And then just to take this company here as an example, maybe in 2016, after you survive the pump and dump, you say that, okay, I don't sell my shares, right? If I don't sell, I don't realize the loss. I'm still not losing money yet. But you'll be holding on to the stock as it continues to stay flat or even continues to go down below 10 cents. And then just in somewhere in 2020, it suddenly spikes up again, but you still haven't really, see that kind of multi-bagger return. You'll still probably be holding on to a loss if you actually bought it here, right? If you bought it at 50 cents, even the stock at 10 cents went up to 20 cents plus, you're still at a loss, right? The real kind of multi-bagger stocks is it won't fall down to its previous low. So like for this example, this kind of stock, maybe before 2017, it was just at 50 cents, right? So it grew the business so well until as of lately, the last price is actually at maybe 3 ringgit and 50 cents. So the 3 ringgit 50 cents valuation of this company will not suddenly go back down to 50 cents level. It's not like what we see here on the left side, which is more of a pump and dump, but it's more of a multi-bagger kind of a pattern in terms of the share price movement. So you can see it's straightforward. You put the share price historical, the longer you hold it, the company on the right, the more likely you will see the share price appreciate, whereas on the one on the left is just basically based on luck lah. Some days down in the near term future, mid term, or even very very long term future, some kind of attention goes to the stock, and then it will start to pump the stock price up, but it will not sustain. It will always come back down. So to understand what actually make share price go up and down, we need to really understand what is actually happening in the share market or in the stock market, right? So there will be two very basic reasons that make the share price go up or go down, right? So if a share price goes up, straightforward, there can only be two reasons. One is because anticipation that the business will continue to grow, will continue to flourish, will continue to be better, then people will want to buy to the company stock so that they get entitled to some sort of earnings or even the dividends. Sometimes you can also have unreasonable kind of experiences where nothing is going to happen to a company, but due to unforeseen market sentiment, the share price just go up, and then but because there's no growing business or fundamental reason behind that, then of course the share price will come back down again, which is what you see in a pump and dump lah. So for traders, they definitely will enjoy either one. If they can really anticipate which company share price will go up, they will always be on the hunt on the next company with the tendency to have their share price to go up. But for value investors like you and me, it's very straightforward. We only look for good growing businesses, and this actually puts us in a position that we really focus and really go deep down to find the best businesses. And even though if the share price might correct downwards, we will still take the opportunity to buy more, because we know that the longer we hold, the tendency for the company share price to go up is even higher lah. So of course, to put it into perspective, the market will always go up and down, and the scenario or the observation would be just like what you see on a weighing machine scale when you have Garfield the cat jumping on top of it. It will always, when you have someone jumping on a weighing scale, the numbers will always go up and down. It will be irrational. But if you are an investor, you wouldn't care. You wouldn't be distracted at any one time when Garfield lifts off from the weighing plate, or when his legs touch down on the weighing machine, how much is the weight. But you should always know this cat has been eating, as it's maybe 5 years old, and has been eating this much kg of food. So even though that the weighing machine readings may be jumping up and down because of his actions and jumping on top of the weighing machine, but you will know that it doesn't matter. I know that the weight of this cat is probably at just 2 kg, because this cat is my pet, and I roughly know what is his weight, and doesn't matter what he jumps, what are his actions, what weighs or what numbers appear on a weighing machine is not important. And this is what we want to really put into perspective, is that you don't want to focus on the fluctuation on a daily basis, but rather actually focus on what is the value of the company itself lah. So there's also some kind of understanding you must extract from the word value. A lot of people, when they look at value, be it value meal or even value buy, it's always because it's cheap, right? We have been so-called molded into this kind of mentality. Whenever you see something is on the discount, it will always tell you, oh, this is a value buy because previously it was just 5 ringgit. Now you can get it for 4 ringgit, and this is value. But there's another perspective to the word value, which is valuable. Valuable, when you look at it, is totally different from what value buy is, but it's something that is so niche, that's so one that is so 1 in a million kind of position. That means there's only one of it out of so many million of it, and it's going to be special, and hence it is valuable, because you cannot find it anywhere else. So when it comes to value investing, we are not trying to look for the cheapest stock, but rather the most valuable, the most attractive kind of business model. Because once this business continue to grow, continue to sustain, you will definitely see the share price goes up. Because this is our belief as an investor, is that once we buy hold of a valuable company, the share price should actually tag along with the company's performances. Of course, to maybe portray in a more simpler picture, of course, for you guys who do watch football, you would know that one of the still very popular, or even one of the best players in the world right now is still Cristiano Ronaldo, already 30 plus years old, but is still one of the very best. And his, of course, price tag is around 60 million euros previously, few years back ago, and he got transferred to Juventus. Then, of course, there are also, influencers, or even so-called jokers, or I would say internet celebrities, who also have their own net worth. But if you were to actually build a football club and you want to win trophies with a football club, you can actually, you are given the opportunity to buy Cristiano Ronaldo with 60 million euros, and you have the money. Would you rather spend it on a good player, or rather a normal or underperforming player, which won't really perform that much in terms of his performances? So it's not buying cheap players, nor is it buying cheap stocks that will really bring your investments to the next level. But you really need to buy the best player, or even buy the best companies out there, so that they will actually help to push your investment returns, or even your so-called performances, right? You want to buy good players, you want to buy good companies and good stocks and good business model. And of course, how do you actually find value in a company? What actually dictates or determines what company is a Cristiano Ronaldo type of a company, what company is normal, or even not a very good kind of business model kind of company, right? Maybe our hands pass it to Chun Beng to dig deeper. How do you actually find value in a company? How do you find the Cristiano Ronaldo or the Lionel Messi of a company to invest in? Chun Beng, you need to unmute yourself.
Sorry. I think there is a couple of steps for you to actually validate. Of course, to identify what is the way to find this kind of multi-bagger stocks. But to be honest, for me and Jupan, the very first thing that we will do is we will try to analyze the business model behind the company, because this business model is like the fundamental. And then, of course, if you have the business model right, maybe it doesn't really scale yet. It can be due to timing problem, or the facility is not up to par. So for example, this is 5G related stocks, and then it requires a lot of facility being set up that way. So once the facility is in, then of course it can actually realize the value. And a lot of it is surrounding on this part, but fundamentally is how this company make money and what is the characteristic around it, right? So maybe we can go through a few examples to help you do a side-by-side comparison on how you can justify a business model from different companies, right? So of course, the first picture we will try to show here is technically, if you see on the left is a coffee shop, and then on the right is another franchise. Underneath, they are the same thing. They sell noodles. If you try to actually make a so-called apple to apple comparison, right? But of course, you as an investor, I think probably we have this kind of trade. So every time we visit some shop, we try to see what this coffee shop can make a lot of money. And then you try to think how they can make the money, how many staff they employ, and then how much they sell for the coffee, and then based on your own knowledge, then you know how much margin they are making. Then you start to calculate, wow, this guy, this boss must be making a lot of money, right? So the same thing is why we wanted to show this side by side is because selling the same thing doesn't mean their business model is the same. How you sell the same thing differentiate you from the different competitor. So the same, both of them sell, let's say pork noodle, for example, or any type of noodles, right? The one on the right is the one that try to replicate on the same effort they put in. So they have a great recipe. Instead of using the same chef that's super talented, keep on producing, let's say the output is about 200 bowls per day. Rather than you turn this thing into a formula, put into a central kitchen, and then you sell it up to different outlets, and then you can replicate in a very fast pace. So this is fundamentally the difference between a place that sell noodle. So same go to for a company that sell cloud services. Malaysia also got a lot of listed companies say they have cloud services. Yeah, a lot of them, yes, they are right. They sell cloud services, but then they underneath they are just reseller, meaning they are at the downstream kind of player. They resell Microsoft Azure, Microsoft product. They resell Google Cloud. They act as a consultant. How much a consultant can make out of all this game? So it's very hard, and then it cannot scale because you become the uncle that work very hard. One day you try to actually cook 200 bowl, but this is the maximum capacity. Even though you hire a few more staff, maybe you can go to 300, for example. But if you replicate it from a central kitchen point of view, maybe in 1 year you can go out to 3,000 plate per day, for example. Right. So this is one perspective. If you move on, then you say yes, Go Noodle is great. But there's another bigger player in the whole world where it's a restaurant that serves affordable fast food throughout the whole world, different culture, different location, different type of people that have different flavor of food they prefer. So McD is a very classic example that they can replicate this whole thing. So that's why when you see when people sell certain products or whatever not inside a listed company, you need to underneath you need to think, is it easy for them to replicate or resell? Right. So for McDonald's, they are not selling burger and those things. They're selling their brand and a very efficient way of managing their staff, managing their raw materials, controlling their food quality, and so on. So you can see, even though they go on drive-through, it can be quite efficient. You are the guy that you pay don't know how many 100,000 to actually buy the license for you to operate the business. All these things come together. You go in like a trainee, and they tell you how to use this machine. All these things is actually formalized. You wanted to do the French fries, put in 5 minutes, and then come out, and then let it cool down for 30 seconds. All these things formalized, and then they even got a system to track. So this is the thing that maybe Go Noodle also cannot go down to that extent. But what they can do is they give you all the raw materials from the central kitchen. You just heat it up. But heat it up, someone heat it longer, someone heat it faster. Then the food quality is still not the same. So that's why we should always try to find the best of the people that, let's say, sell food, and then you go for it. Likely you'll be able to find the Multibaggers company. So this is some of the example that we want to put in. Of course, if you take out from our daily example, then the next slide actually give you the perspective of when you wanted to find a Multibaggers, basically is how you're able to find a great and scalable business. So again, comparing to the left and the right, of course, the left is the main theme park, very popular theme park, Genting Highland in Malaysia. Hatta Lega, on the other hand, is a factory that produces gloves. Regardless, maybe from our perspective, from short-term wise, you would think Genting probably give you more value because Genting got tagged under the recovery stocks. And then once the thing open up, then you'll be able to get some, for example, some gain, 20%, 30%, you won't know. Harta Lega is already right on the wave, and then it's already maybe hit the peak, for example. But from a business perspective, business model perspective, of course, you will easily link that Genting is not that easy to replicate. To find the same spots, cool weathers, can have a casino, a license, or whatever not, it's quite difficult to replicate, let's say in Labuan, or even in Kota Kinabalu, and so on. So you can only have one in Malaysia. Maybe you're lucky, get another one in Sentosa, Singapore. And so this kind of business is a bit hard for to get multi-bagger in the long run, but you can maybe get a very good dividend yield lah. So because this thing is consistent, it's growing, then you can get some good return. But our topic today is about multi-bagger, meaning you're able to get a very good return in coming years. So Harta Lega, if you invest in them in a very early day, thinking not really linking to COVID, basically growth is actually required, especially for manufacturing of food. So for example, a lot of factory staff, they need to actually put on this growth to actually do QA or whatnot. So it's a need. So if you can identify them in the early stage, then of course, it's quite easy for you to achieve the multi-bagger, to identify them as a multi-bagger and then of course reap the returns. So these are some of the examples. So of course, there are two things: how to identify from the early stage. So you see how they're going to go, what style of business they are doing. Then you think it's coming. For example, electric vehicles. For example, 5G related stocks. So all these futures, Industry 4.0. And then, of course, what we want to do is we'll try to find the best among them. Then you, with your risk profile or risk appetite, then you put accordingly. Of course, don't put everything in one basket. You will not know when they are so small. When they are small means it's quite easy for people to overtake them by competition. But if you put like a small bet in multiple basket, then quite easily you can get one, for example. But later, Japan will share with you how about those already proven as a multi-bagger. Then should we get away from them or we still stick to them? So there's a few more things to actually put in perspective. Of course, if you put it into super layman, for us to find a great and scalable business, come from a few factors. So the first one is very important is for us, leadership is very important, especially when we talk about multi-bagger, because they are the one that actually will tell you their vision. Vision is not something that put up a motherhood statement, not going to achieve, and then you just treat it as a normal statement inside some reports. But the one that actually have the capability, they really can realize the visions. So for example, on the left is the management team from Vitrox, and on the right are the founder from Tencent. Tencent started off they started off with a few internet businesses, but they very focused into social media related stuff. So they founded QQ, a very similar thing like MSN, but then a China version. Eventually, they ditched this web version, turned into another mobile version called WeChat. Also, arguably, you can call it is a replica of WhatsApp, but if you compare what we should have right now versus WhatsApp, you know they have innovated along the way. So a great business, a great leader, maybe they can start off by copying someone's ideas, but they are the one that can actually make it into a long run and still continue to reap some benefit and still able to churn some money. So of course, leadership is the first thing. So how to actually identify all these guys if you are trying to find those early stage or very new company? There are a few ways. Of course, if you talk about US related stocks, one of the best way is Google the founder names. Try to go into website like Crunchbase, that usually they will link them to what is the previous company those guys has founded. So, for example, Ponima, he didn't start off with Tencent straight away. He have a few startup, and of course, this is the one that actually managed to go. Then you will know their style. So one of the classic example that if you're interested to find out more is the founder of Luckin Coffee. You should really try to find this guy, find these people out. They are the same group of people, belong to the same type of venture capitals. They do the same about the same thing. They try to list something, some service very popular, very hit, for example, bike sharing or whatever not, and they try to get it listed very, very fast. And then eventually they will try to sell off all their share. And then they cash out. Eventually the business collapse. So the same thing, actually they repeat the same thing all over again when they started this thing called Luckin Coffee. And it repeated the same thing. Repeated the same history. And of course, Luckin got delist. I think they still listed in US, but then the share price got tumbled a lot, and then all the management team being kicked out. So these are some of the examples that you can try to identify. What is the profile of this founder previously, especially all this new tech company in US. It's quite easily that you can find it out. And then of course, on the other hand, are the two guys, you might know them or you might not know them. But they are somewhat related to some company that is very famous, but it didn't perform at the end. So on the left is a company from Germany, if I'm not mistaken, called Wirecards. So it's like a cashless solution with some sort of card solution, and then it actually make up a lot of promising stuff. Although losing the whole portfolio is losing, but they're still able to convince the investor to keep on putting hope in them and keep on investing. But at the end, this guy ran away and the whole business collapsed. And on the right is another example of bad leadership. This is the management from Lehman Brothers. Of course, got hit quite badly during the subprime mortgage crisis, and eventually the whole thing collapsed. So good and bad leaders usually is easier for you to detect for those new companies or relatively new listed co, because what they try to do in their previous startup, most likely the style will be almost the same. But for a very successful or a company that's already there for, let's say, 5 to 10 years, then it's a bit hard. Although we put out an example of these two men, but in reality, it's a bit hard to actually identify. That's why for us is the easiest way is to Google them out, try to find out their history. Maybe you can put an eye on all this. Then moving on from leadership is quite straightforward. Some of the good example of leadership is when they are in that place, they tend to groom the next leaders so that they have successor to continue to run and realize their business. So you can see one of the example is if the company are having the good ecosystem or a good mechanism of finding their successor, typically it will be able to sustain their company performance. So on the left is Microsoft Corporation. Although the whole share price tumbled a bit after he moved to Steve Ballmer, but then subsequently the current CEO managed to actually turn it around. So it was also quite important. Besides having the next leader, who is the one that in charge also the one will actually give you the different confidence level. On the right is actually Google or Alphabet's Inc. The current CEO is actually American Indians. So far having a very good track record and still growing. So this is one of the few things that you guys can identify if you talk about this leader perspective. Then moving on is after we have great leadership, then you talk about the company vision. So you need to definitely try to keep an eye on what is the CEO statement after they take over. And if you don't have confidence, maybe you take, let's say, 1 to 2 or even 1 to 2 years to actually monitor it and whether he keep up to the work, to their words. So for Microsoft is a very classic example. After Satya Nadella actually become the CEO in 2014, he just put out one word. He wanted to actually put full force in cloud related business. So he really walked the dots. He turned all the Microsoft services into cloud. So you got Office 365. He put a lot of focus in actually cloud services. And then you got the Azure services that start to be able to compete with Google Clouds and even AWS, Amazon Web Service. And right now, even we talk about for tools for work from home, Microsoft Team, maybe he's not the one that launched first. Of course, Google Chat have it first. And then you have Slack, on the other hand, also doing the same thing. They themselves reinvent their whole thing. So they got Microsoft Skype, or the corporate version called Microsoft Link. Then they reinvent themselves, become Microsoft Teams. And all this is proven to be right. Cloud first, mobile first. And this is the reason why you are seeing a 20, 30 years old kind of tech company still hitting the historical high in terms of the market performance. I mean, even today, it's still going up, despite the P remain about the same, 30 to 40 plus. It's not like crazily go up 100. So this is some of the example. Then moving on is after they have the clear vision and also the great leaders, then basically we need to know where are them in terms of the upstream and downstream of the business. Of course, the more towards the left, the better, because technically have higher control into determining the price, right? So it's one of the example. And then if you already have a very strong knowledge or strong know-how to manufacture certain thing, then what's next? So the next thing is basically how you are able to actually put out a formula to replicate the whole thing in a very fast manner. So you can see they can go up from 1 factory to 2 factory to actually 8 factory easily. So this is something that very important. So as long as the same thing have his demand, then replicating the factory is one of the key things that you can see. So for example, if you think me technovation is good, always got demand, not seasonal, for example, then supposedly they should keep on expanding the capabilities. Of course, if you study deep enough of me technovation, you realize it's quite cyclical. Depends on the client capex cycle. Good time, they get 3 big clients. Fantastic, very good quarter performance. I think the latest one seems to be good. But if you go to the next quarter, then no more, then it can be very bad. So very cyclical, up and down. But if you take one example, which is Vitrox, one of the best, I would say, tech or manufacturing company in Malaysia, they are the one that putting something services that a lot of people need, and he can survive through the entire cyclical season, because they are doing inspection system. Without, I mean, good time, bad time, good season, bad season, you still need to actually do all the inspection process. That's why this thing is actually required. And you can see Vitrox has been growing ever since they launched. And you think they already hit the historical high. Guess what? The latest quarter, they prove you wrong. They continue to grow. Right? So I think, so these are some of the example. Of course, I think the latest one is hovering about this price, but you can see it's quite stably go up. If you invest on the earlier day, you already managed to collect one of the multi-bagger stocks. I believe Japan is one of the lucky, not, I wouldn't say lucky lah, one of the guy that able to identify them in the very early days. So we managed to collect one Infinity Stone already. And then another grooming strategy is maybe you will hit certain threshold when you try to grow certain business. But another way is, if you can see, they try to increase the potential of the business surrounded by the same thing. So for example, you you are in property development, then you can go into construction, go into renting or whatever not. So one of the business you can continue to find out the potential and then have a second business, maybe not related to construction, let's say in tourism. So you can have tourism, so you can actually put another focus into transportation or whatnot. So this is another way that you can see this leader really have a good vision in growing their business. So maybe you think construction, tourism, yeah, not sexy, cannot really go up in the future, but they got multiple of these and they do it really, really well within each verticals. This is also another good way of telling you they are actually putting the right strategies. So maybe this is very hard to imagine. So we give you an example of a Malaysia company we think is quite good in what they are doing right now. So one of the example is Scientex. The one on the left and on the right, I would say it's very hard for you to link. On the left is plastic manufacturing for you to do your containers or whatever not. And then can't you use the plastic to build a house, right? So they have two totally not related kind of business verticals, but each of it actually doing very, very well. If you actually monitor through Scientex, they don't really give you a very sexy dividend yield. I mean, they do give dividends, quite stable, not like 8%, 9% annual dividend, for example, but they give you some dividend, and their PE is always the same. Then you think, then how to become multi-bagger like this? So the best part is P about the same, but their sales revenue keep on going up. So meaning their sales revenue go up like that, profit go up. Then PE remain. Then what's next? The share price go up lah. So this is a beauty of Scientex. They have been proving themselves for the past few years. So meaning they didn't replicate to a lot of different factories just doing plastic, but they do two different things and it's still doing quite well. So if you guys are not familiar with Scientex, the housing development, they're focusing into low cost house, which is quite echoing with what Malaysia is going to do moving forward. More Rumah or whatever, not more affordable housing township. So they are the one into this, although not as popular as, let's say, your EcoWorld, Setia, Masing or whatnot, but they are very focusing in just one area, affordable housing, and they are doing quite well, churning monies. So this is another example of good growth strategies. And of course, you see the share price. Beside the time that 2020 got hit by pandemic, all the stock gone, they go up like a straight line going up. So this is another example that I wanted to share today from Malaysia. And then the next one is also QR, but of course lately their stock slowed down a little bit. Mainly due to a lot of reasons. MCO definitely one of it. Hitting the impact of their family mart expansion. And then they also have a few business try to cover each other. They got palm oil, they got all the frozen food and whatnot. But if you take out the pandemic effect, you can see their revenue keep on going up. So this is where another good type of company, if you let's say collect them in let's say 2-3 years ago, easily you already get a very good returns. Yeah. So this pretty much sum up an example on how we're able to identify multi-baggers companies. But then, like I say, it's easier for you to identify those stocks in the earlier stage. But if let's say this guy is Microsoft, they already proven they are able to grow non-stop for the past 10 to 20 years. Can you still believe in this? And I will pass this to Chupan to continue with the presentation.
Okay, thank you, Chun Peng. Of course, when it comes to finding multi-baggers, the business model of the company is important. You need to be able to scale your business, and scale have a lot of perspective to it, right? You can have multiple outlets in Malaysia is considered scale, right? Compared to your, warung or your small kopitiam in one kampong against a franchise throughout Malaysia. The franchise that can grow throughout Malaysia is better. But then you compare it again to a multinational franchise that sells fast food all around the world, then you also find out that in terms of scale, there's so much better examples in terms of scalability, right? Not just McDonald's, Starbucks as well, which you can find all around the world. And then, of course, then you will come back to the next question that we will want to ask. So we already know that this kind of criteria make sense. Firstly, your scalable business model. Secondly, your good visionary management. Then, of course, the next question will be, okay, so I already know that this company's proven to be multi-baggers. So can I still invest into them or not? Right? I would just run you through some of the questions that you might need to ask yourself first. You can actually invest into proven multi-baggers if they pass some of these questions that I will usually ask myself. Can the company continue to grow its current business? So yes, it has proven, it has grown 100%, 200% already. But you think that if this company, if I buy it now, it already goes up by 200% already. Can it still continue to go 300%, 400%, 500%? Then, of course, you need to ask yourself whether the company is able to still scale the business as it is as of currently, right? If it can still grow, got chance, right? Because if you cannot grow already, then confirm no chance already lah, right? So continue to grow its current business. If they can do it, then there is a potential possibility that it can still scale the business. And then the next thing is, when you talk about scalability or growth of a business, we also need to understand not all business are created equal. Some business are evergreen. Say for example, FMCG, right? No matter how many years pass from our grandparents' era to our parents' era until to our current age, we still need to eat to survive, right? So your food manufacturing companies are the ones that are more likely to be evergreen business model. 20 years down the road, still people will need to buy food and eat to survive. But look at other kind of business model. Say, for example, our media companies. So your Star Media, your companies previously, that was the dividend kings, right? Back then, there was no internet. People rely on newspapers for their news and also their information. Your newspapers were actually bringing in a lot of money because first they sell newspaper to us. Secondly, they were actually accepting, advertisements from people who want to advertise things on the newspaper. So they were the old grandfather version of Facebook. Facebook is now digitalized newspaper. You basically get information, your news from online now because the social media has actually taken over the business model of the traditional press and traditional media. So if your business model is going to be impacted, it's not going to be evergreen. So definitely you cannot anticipate that the company can continue to grow because the business is going to be obsolete already. So if it fails the second question, then of course, most likely the company will not be a multi-bagger. And thirdly, will the management try to grow the company's future growth? So, sorry, when you talk about how the management will steer the company towards the future, they'll always give you every year in the annual report what have they achieved and what they want to achieve, right? Because they want to give some sort of confidence that the company is still trying to grow, and always read back the previous year's annual report and then this year's annual report to say that whether they actually walk the talk or not, right? So the last year's actually were going to give us an insight of what they are going to achieve or plan for the company as of this year, which is the results that maybe are showing already. So if the company management can actually walk the talk, tell you 1 year ago, I'm going to build one factory that's going to improve the capacity by say for example 50%, and come this year, revenue grow by 50%. So from there you can know that, okay, I might not be inside the company, I might not be able to visualize the sales, but this management is actually walking the talk. When they say they want to grow the company, they want to grow the business, they really mean it. They are not just talking, because there is proof that when I read back the previous year's annual report, they are walking the talk. They actually made the promise, and then they actually fulfill the promise already. So you can actually gauge that also by how the management wants to grow the company's future. And then, of course, one of the other key aspects is that, yeah, this management is good, no doubt about it. But as we all know, we have a limited lifespan on Earth, right? So what happens if this key management or key person actually retires, right? Who is going to actually continue his this company's growth plans, right? So another good thing or good question you need to ask yourself is that, yeah, okay, the company's business is not going to be obsolete. It will still continue to grow. I have a very happy and dedicated manager right now running the company. But when he retires, someone is going to take over, and that someone is also someone trustworthy. So even though the management can be very relatively old, 70 years old, but he has already groomed a successor, which is 40 years old, then you should be well rest assured that even though when he retires, the 40-year-old new blood will actually come in and then not only make the company better, but also introduce more opportunities so that the company can grow faster, right? And then let's go to the next step. So, of course, there's also questions angle about tech companies. So tech companies are well known to be multi-baggers. So when you actually gauge a tech company in terms of the multi-bagger potential, you will need to ask yourself, right? What kind of tech company is it? Is it going to be a US tech company like your Amazon, your FANG stock? Or is it going to be a Malaysia tech company? And Malaysia tech company usually will be the, semiconductor and stream kind of players. You still need assets to actually run a business. So you need to actually have the technical know-how to build the machines, build the visual inspection machines, and then, help people to do packaging of the so-called semiconductors, right? So these are what we call a little bit more capital intensive business. They need to build lines and build factories and then sell it to each other, especially for the Malaysia tech companies. Whereas for the US tech, like for example, Apple, they don't really manufacture the phones themselves. They actually ask another tech company like Foxconn to actually do the heavy lifting in terms of the manufacturing. They are the ones who give them the permission to make a phone with the Apple logo and also the brand, right? So this is something you also need to understand as well. We also talk about it in our semiconductor sphere. If you actually want to gauge the potential of a Malaysia end-stream tech company or semicon company, you also need to understand who are their front end or upper stream clients, and will these upper clients do well? If they do well, only you will have a trickle effect down to your end stream players to continue to do well as well. And of course, we talk about Malaysia tech semiconductor. Their business model is also not evergreen, right? Some of their technology and their approach when it comes to testing semiconductor is obsolete and can be, taken over by newer technology and newer approach. And just to give you two examples, on the one you have on the left hand side, which is KESM, which do real testing on semiconductor, but their method is invasive, meaning to say that they will use the burn-in test method. You will take a component or package from the line, and then you need to test it under high temperature and under prolonged usage. And this kind of inspection or testing method not only takes time, but you actually sacrifice the component that you use to make your test. Whereas for visual inspection, you actually put a camera and you actually utilize maybe infrared technology to actually scan through every single piece. And if there's a defect, they'll kick it out. If there's no defect, it continues to each of the processing steps in the so-called wafer level packaging. And also, of course, the other one will be another company in Singapore, which is Veritronics, which is also a bit obsolete when it comes to their technologies in terms of the semiconductor end-stream player business model. So actually, it's not difficult to find a multi-bagger stock. You just need to be very confident that the business will grow. Someone good is actually helping us run the company. We are not the chairman or CEO. We don't go to the boardroom meeting, but we buy the company, we put in our hard-earned money into the company share because we have trust that someone ethical and visionary is actually helping us run the company well. And then last but not least, your business can be the best, your management can also be the best, but if it does not have a growth plan, it also will not grow. It will just be probably a very good dividend company because you already reach a certain size. You can continue to bring money, but the money will serve no purpose because you cannot grow, and you actually give it out to shareholders as a dividend. And when you give it out, it won't actually trigger the share price to go up. You will just continue to run your business as it is. You won't build new factories. You won't increase your revenue. You have a good business, but you don't have a growth plan. The revenue will not go 20%, 30% up to actually justify the share price to go up that fast as well. So we will go through some of the, criteria of what a good business model is, and also give you a few examples. So some of the good examples of a good business model, it can be broken down to four categories. We actually put it as control of resources and power, the first category. The second one is technical knowledge. The third one is scale. And last one is actually sticky factor. They can actually be a combination of all these four, but just to actually give you a gauge, we will go into each business model individually. So when we talk about control of resources and power, you can also link to intellectual property, right? So companies that actually control, have this kind of trait or criteria, right? They are maybe companies that have ownership on certain things, land, data, raw materials, intellectual property, right? Or maybe they have a very good relationship with the suppliers. They have very good relationship with the clients, and then they have some form of unfair advantages, right? Say, for example, legal monopolies, patents, tariffs, licensing, etc., right? And these are the characteristics that you might find in a company that can control resources, power, and IP. And how do you determine it? Basically, they will always tell you that, okay, I have the intellectual property, the ownership. Only I have the technology to make this kind of thing, to control this kind of processes and what's or not. And of course, they have this kind of control, and then you can actually see that they are actually the party that is the key revenue contributor of their suppliers, right? So if you look at their suppliers annual report, you see that they are actually pumping in a lot of the so-called expenses to this company, because this company is really the monopoly in certain kinds of products and services. And then you also will not be able to find other close competitor. So they actually have the lion's share in terms of whatever products and services that they are doing. And sometimes they are so strong that they can even dictate supply chain routes and also the channels, right? So right off the head, without thinking of the example there, exclusive distribution, supply chains, routes and channels, your Swiss Canal is one example, right? The Swiss Canal, people need to actually travel from Asia to Europe without going through the Horn of Africa. You actually have to pay the Swiss Canal a toll to actually pass through, to cut short your traveling time by 1 or 2 weeks. I think 2 weeks. So that is what we call exclusive distribution in terms of controlling supply chain and also channels. And of course, companies with the more well-known IPs would be Walt Disney Company, right? Whatever content coming from Walt Disney Company, be it Mickey Mouse, be it Star Wars, be it Marvel Comics, everything is tied back to Disney. If you want to legally create a birthday cake with a Walt Disney character, supposedly you need to write to Walt Disney to ask them, can I use the picture of Mickey Mouse on my cake? And then they say, yes, yeah, you have to pay me X amount because you are using a character which is under the Walt Disney, the intellectual property. So these are the examples where Walt Disney Company can continue to make content, be it movies or even dramas on their intellectual properties, from Star Wars to Marvel Comics and even their new and upcoming character creations as well. And of course, they can also use the same kind of IP to build it into a theme park or license it out to a toy maker to make toys. Very straightforward when it comes to control of resources, power, and intellectual properties. I'll pass to Chunbeng. The next one, which is technical knowledge. So how do we actually gauge the technical knowledge as a moat or as a good business model for a multi-bagger company? You need to unmute, Chunbeng.
Okay, so I think this one is quite straightforward because if you guys already went through our semiconductor sphere session, this is a very classic example that you are the one that know how to do this, and so far there isn't any competitor can catch up with you. But to actually understand this is to take a few challenge. So of course, for this type of characteristic, you need to have a little bit of technical knowledge, or you go through a lot of research yourself to be able to identify whether they know how to do it, and then whether they are having an advantage or not, right? So if you are not familiar on how to identify all this, so basically you can check from two things. One of it is whether their profit margin is very high or not. Typically, when the profit margin is high, a certain control means the people needs them. Okay, let's say the first thing pass, profit margin very high. And then the second thing that you should actually look into this is whether they have customer that keep on coming back. So for example, you have one customer coming back to you for 2 years is fine. But keep on coming back to you, for example, on how Qualcomm and Apple going back to TSMC for at least 5 to 6 years, then you know this guy definitely has something, right? So, but of course, for us to know this, let's say for us to say TSMC is at the best, is at the leader, from current standpoint is easy. But how to actually know all this behind I mean, let's say 3 to 5 years before, it's a bit challenging. That's why you need to be able to believe in certain trend. Once you identify into a certain trend, then you need to find the let's say top 3 leader. Because if you're on the right trend, definitely you will show. So for example, if you look back into semiconductors, things, and let's say you believe in 5G, you just put your money invest into all these companies, definitely you will get some returns. But some might be good, some might be bad. That's why you cannot put everything into one stock, right? But for me, is you need to identify the trend as the first thing, and then try to look up to the first few guys that are able to have a few repeating customer and able to imply some sort of good profit margin at the first place. Maybe this is like the way for the identify. Then you can put the bet on them, and then who knows, you will actually hit one of it. And then I think we can go to the next one on another way to tell whether they are a good or a good trade of a multi-bagger stocks.
Right.
Yep.
Yeah. So I think the next one will be scale. So scale is straightforward. Basically, the company can put up a new factory, and once this factory capacity goes full, and then they will put on a new factory again. So once they have this kind of ability to scale up their businesses, so if, say for example, the plants are situated so near each other, yeah, you still need operators to run the machine, but instead of employing one factory manager for each factory, if you have a big complex, you can just straight away hire one complex manager to oversee a few of these factories that are situated close to each other. This is how scalability works. The revenue can grow, but the profit will grow faster in terms of percentage, because in terms of the cost efficiencies, the company managed to tap on the so-called the economies of scale, right? So you can see that how they will grow is actually they can maybe do merger and acquisition. They can buy up a competitor, consolidate the market, and then hence command for a better margin, or they have a very clear expansion plan by which year I will build a new factory, and then when this factory capacity full, I will then build a new factory, and will continue to do so without ever coming to a stop. So if the company can continue to build factory, it will always mean that the company has the expectation that they can earn more revenue. And once they can earn more revenue and the profit tag along, you also have a tendency of a higher profit earnings per share, and also eventually a higher share price. So one straightforward example will be Scientex, or even your glove makers as well. And the last but not least would be maybe sticky factor. So how does sticky factor becomes a good trait as a good business model for multi-bagger companies?
Yep. So I think it's quite straightforward for sticky factor is how you actually see the product having a repeating purchase from the same customer all over again, right? So Amazon is one of the example. I mean, Amazon is one of the example. Majority of the e-commerce deploy the same model where you are able to actually build this kind of platform business. And then when you have the platform business, you have customer, and you also have the businesses or SME that provide the products. So for you to be able to increase the whole thing, so first you need to learn the patterns, connect the right guy to the right merchants. This thing takes time. But once you get this thing up, you have more and more sales, then you have nego power to say, to get the merchant give the best services to the customer, or another way, to the best customer. So the best customer means they are the one that keep on spending, then they get more loyalty coin, and then they can get reward, they keep on coming back and then get good service. If this thing come back all over again, merchant keep on coming back to you because got sales, customer keep on coming back to you because of got good deal, then they can't get rid of you. So you as the operator can be earning from both sides. This is some of the example that you will be able to benefit from the sticky factors business model. But of course, if you talk about how to actually determine it, we put in a few ways. Of course, subscription model is one of the great tactics because it's predictable, keep on coming back, got repeating purchase. And then the user base is already big. Once they monetize, then it will be a very sound or very great return. Active user is there. Not just user, but for active user, people keep on interacting, keep on buying. And lastly is they keep on coming out with new business. They can tap on all these captive users base. For example, Shopee started off as an e-commerce company, launched the wallet for you to enjoy cashless transaction, not just online, but you can spend offline in, let's say, your or any grocery store or whatnot. After they do that, then they got all the wallet features, and then they also got people that can going around to deliver the stuff to you. Okay, if I can deliver stuff, why not I can do on-demand delivery for you to actually grab a food. So they wanted to expand the service into Shopee food as well. So this is some of the way that you build something that people like, and then the merchant like, then you got all the volume, then they keep on expand your influence. So this is how you can enhance the sticky factors. But of course, all this is theory. For me, maybe for you, it's also hard to find out how. So I know all these things, but usually I only realize after the customer, after the company becomes so successful. That's too late already, right? For me, there's two options. So if they are already great and no one can actually disrupt them, then you can continue to invest. Then maybe you cannot get multi-bagger, but still good return. For example, you let's say like early of this year, you put the money in Microsoft Corporation. I think easily already go up to 30-40%. For example, I think back then it's about 220 US dollar. Now it's about 290 or even close to 300, for example. But then might not be sexy. So for me, another way is quite straightforward. I like to find out something that's already proven. But you're saying this is new company, how you can say this is a proven business? So one of great example is somewhere else they have did it successfully. They try to replicate into a new market, but different guy. Then maybe this is some of the way that you can try to catch. For example, Tencent did it so well by copying the model in Amazon, and then you miss Tencent, you miss Alibaba. Of course, right now got some crackdown in China. If you take this aside, the business itself has become so good. Then you know e-commerce going to be great. US proven, Europe proven, China proven. Southeast Asia will be the next. Then who will be the one? SEA will be the one. So let's say Shopee is the one that definitely growing. So you can definitely see them as Tencent or even Amazon in their earlier days. Of course, you might say, wow, losing money so many quarters already, and how come they can still justify all the share price? But this is one of the way for you to link. Same thing, but different place. Usually it won't run very far. And most importantly, behind SEA is actually Tencent, the same guy that did it successfully in China, and then they try to replicate in another region. So this is one of the way. So the second way is you tap on the future trend, 5G, electric vehicles, but it's a bit hard for you to find out. But if you don't want to lose the opportunity, then maybe you can just go into ETF. So if you think this China crackdown, you wanted to actually invest, put some money into ETF. If you don't know which one to choose, at least you don't miss out the opportunities. Or you think semiconductor will continue to be evergreen for at least 5 to 10 years, then go to the ETF. Secondly, for me, another way is everyone talking about cloud. You cannot go into cloud anymore. I mean, you can go into it, but don't expect to be a very high return. So you try to think cloud fundamentally is what? Cloud is like a storage place. It's like your bank try to store your jewelry. What is important in all this service? They need to have a security guard. They need to buy insurance or whatnot. So if you miss out the trend in cloud, then you should go into cloud security, for example. So when cloud becomes so big, the next thing is supposed to be security because this need to come hand in hand. Whatever thing that happened before in the traditional way, all the services surrounding it will follow one. So you talk about ride hailing. So eventually ride hailing, like for example, Grab, all the drivers still need to pay for all the license. They still need to buy insurance. It still go back to the same thing like taxi. It's just different model, a single company make money out of it. So if you already miss out a mega trend, try to find out the things surrounding it. So for example, cloud, don't go for Amazon, all those things. It's a bit hard. They're already so big. Then go for cloud securities, cloud, there's a lot of things like CDN, cloud delivery network, a lot of other things can be quite technical, but we try to find these kind of things surrounding it. They most likely will be the next thing. So 5G is already there. Telco is definitely there, but what is the next thing around 5G after this thing got set up? Maybe telemedicine and whatnot. So this is how you can find out and identify the trend. If you can't, after that identify the trend and you find out it's already late, then you try to find the services around it. And then of course it's hard lah. Wow, all this is fantastic. And then got 5 company. Then don't put the bet on the best one. You might not know, maybe the second guy overtake it. like very easily. So you still need to put it equally, like in my personal opinions. So I think like a few questions asked inside the comment. They asked about whether we can focus in Malaysia to find multi-baggers, or we should go into other market. Of course, the easy answer is you should go to uh, other markets, especially US, where you are able to find out more new or exciting technology companies, right? But of course, if you go back to Malaysia, if you don't want to invest outside, then you can maybe try the method that I mentioned. Whatever things that have been proven, and then you try to replicate in Malaysia. Then maybe this is the one that you can go after. But too bad SEA is not listed in Malaysia lah. For example.
Yeah, maybe
And
I
then
would
the
want
next
to add.
I'll pass to Jupan lah. Yeah.
Yeah. If your time horizon is long enough, you can still invest in the proven multi-bag companies, because the risk of the company to fall or even to fail is much lesser. Just that it will take longer time to give multi-bagger returns. Small and young company, yeah, high growth prospect, but high risk, high return. Right? If they don't succeed, then of course the share price will go down very fast. But if it goes up, then yeah, in terms of the time required to get multi-bagger returns, it's a shorter one. So I think it's a risk versus reward kind of trade-off that you need to set. You can have a collection of steady multi-bagger proven companies, continue to invest in them for the next multi-bagger return. You can also have some, smaller allocation for the higher risk one, to test your thesis and to test your so-called emotions as well, right? So the next question would be, what do you think about potential growth companies that is having negative income but have high growth potential, but like Palantir and Neo? You still need to go back to the business fundamental, right? To briefly explain Palantir and Neo, but Palantir is a company that is very good in data analytics and AI to actually help to find some sort of reasoning information behind a lot of numbers and behind a lot of data. So they are very good with that, and their so-called key customer is the government, particularly the Western country governments. So they help countries in the West, or the governments in the West, to track down terrorism activities, to actually nullify these kind of threats, all by actually crunching a lot of data and numbers. So this is Palantir's business model. And for Neo, it's just basically tapping on that in the future, more and more people will buy electric vehicles, and they are one of the so-called early pioneer members alongside with Tesla. So if you have the confidence that in terms of data analytics, in terms of AI, Palantir is definitely different, has the competitive edge over other AI companies, say for example Google or even Microsoft, then it gives you some sort of key indication that Palantir might actually be a potential multi-bagger in the next 5 to 10 years. So, and you also need to understand that one key advantage that Palantir might have is that they are actually happy to accept governmental projects from the Western countries, whereas for Google and Microsoft, they are more of a neutral stance when it comes to that. So that is one key competitive advantage that Palantir actually has. But we won't go through that deeper. And for Neo is how fast they can grow within their China market, and then grow outside of the China market as well, if they want to actually make their car brands, international, rather than just a China focus market electric vehicle. Right. So I think we still have a bit of the sharing of the slides. We will quickly go through all of them first. So very straightforward. It won't be very hard to gauge whether the company will actually grow or not. So you can straight away see from the company annual report, there will be 1 page or 2 page where the chairman or the CEO will give his opinions on how he wants to grow the company, and then you will look at the upcoming financial statements, whether he walks the talk or not. And if they want to actually expand by building new factories, straight away there will be photos of these new factories, piling all these kind of work in progress. There will be pictures and proof, right? No one will build the factory halfway and then abandon it if they are really that aggressive when it comes to growing the company's business. And once that kind of proof come out, you can be more rest assured that the company's plan to continue to grow the business is actually intact and not just empty talk. And of course, one last missing piece that after you analyze all the external factors, which is regarding to the company, regarding to the business model, regarding who is running the company, the last test actually is on our side as investors is actually to give the company time to grow, because no business is going to grow 100% in overnight, right? They say that Rome was not built in one day, and yeah, it is very true. If you want to look at the greatest companies or even the greatest empires, they are not built in one day. You really need to give them time to build the foundations, and then let the company business model mature and how they actually improve and increase their influences and the products and services, right? And of course, it's not me who is quoting to investors like you and me to actually be patient, but Benjamin Graham is that the ones that saying that you need to wait, and this waiting will actually help you as an investor, and those who actually cannot wait will actually sell the companies, the potential companies to work at the relatively cheap price. We just need to buy it from them and then hold it longer than them, right? And of course, his partner, the famous Warren Buffett, is also a key fan in terms of patience. So he said that the stock market is designed to transfer money from the active to the patients. Those who go in and out of the market, they are not likely going to be the richest person in the world. If you remember the few private sessions that we shared with you a few sessions back, the richest persons in the world are the business owners of listed companies. It's not the crypto traders, it is not the stock traders, but these are the so-called founders and the CEOs of a company. Their net worth is really valued by how much shares or how much stock they own within this company. And when they put their heart and soul to grow the company business model, the share price will go up, and so will their net worth, because this is how their net worth is actually tied to the so-called prospects of the share price and the company performance. Right. Of course, at the end of the day, to really drill this into your minds, your good stocks, your good companies, your good investments are going to be your key players when you build your football team or you build your stock investment portfolio. Don't sell off the best players. Don't sell off the best companies. Hold on to them. You should actually sell the ones that are underperforming, that are keeping losing money, keep giving us false hopes, right? Those that actually are louder than their actions, these are the ones that you actually kick it out from your portfolio, and you should buy the ones that are really the potential and the performing ones. So to really end off our sharing for this month is actually to buy valuable companies with a competent management, and they have the plans to grow the company. And as for us as investors, we will need to have the patience to hold on to our investment for as long as possible, and then only you will see your 100% and your 200% returns coming into your portfolio.
So I hope you really enjoyed the lesson and the video. Don't forget to click like, subscribe, and also turn on the notification bell button to get notified whenever a new video like this gets posted in the future. Of course, there are other Premium Club services that you might really want to check out, and check it out by subscribing to our Premium Club members, link in the description. See you in the next video. Bye bye.